The stocks in your portfolio may not be what they appear. Many retail investors buy these names based on brand recognition alone. What we found exposes a pattern most financial media will not discuss. In the 10th place, AMC Entertainment stands as a cautionary tale for investors drawn in by household names. The company carries $4.8 billion in long-term debt, a burden that weighs heavily on its future. Revenues have not returned to pre-pandemic levels, and annual ticket sales are still down nearly 20% from 2019. Chief Executive Officer Adam Aron has sold over $40 million in shares since 2023, a movie that signals waning insider confidence. The traditional 90-day exclusive theatrical window has been permanently cut to 45 days, squeezing the time frame in which AMC can generate box office revenue before films move to streaming. These structural pressures, crippling leverage, shrinking revenue, insider exits, and a shortened revenue window, undercut the nostalgia and hype that often surround the AMC brand. For investors, the numbers reveal a business model under severe strain, not a comeback story. Number 9. Rivian Automotive stands as a stark example of what happens when market excitement collides with relentless cash burn. In 2023 alone, Rivian consumed $5.4 billion in cash, an outflow that dwarfs the annual spending of many established automakers. Despite promises of rapid growth, the company missed its production targets twice, delivering just a fraction of the vehicles originally forecast. After debuting at $78 per share in its IPO, Rivian stock now trades under $15, erasing over 80% of its market value. The exodus is not limited to retail investors. Top institutional holders have steadily trimmed their stakes over the past 2 years, signaling waning confidence in Rivian's ability to bridge the gap between vision and profitability. The company's cash runway still exists, but with burn rates accelerating and production guidance slipping, the margin for error is vanishing fast. 8th place, Peloton Interactive illustrates how fast a market darling can unravel when temporary demand evaporates. Revenues have plunged from a $4 billion peak to less than $1.8 billion in fiscal 2024, a collapse of more than 55% in just 3 years. The company cycled through 3 different CEOs in under 24 months, signaling instability at the top as the turnaround narrative faltered. Pandemic-era expansion left Peloton saddled with $1.5 billion in debt, a load that now weighs heavily as hardware sales stagnate and subscription growth stalls. Meanwhile, competition from tech giants like Apple and Garmin has intensified, eroding Peloton's early lead in connected fitness. The numbers reveal a business that depended on a one-time surge, then struggled to adapt as consumer habits normalized. For investors, the story is less about innovation and more about the risks of chasing a fading trend supported by borrowed money and shifting leadership. Number 7. Beyond Inc., known to most as Bed Bath & Beyond, shows how brand recognition can outlast the business itself. In 2024, Overstock.com paid $21.5 million to acquire the Bed Bath & Beyond brand, a fraction of what the company was once worth. This was not a buyout of stores, inventory, or even staff. Only the name changed hands. Bed Bath & Beyond had already filed for Chapter 11 bankruptcy, with all physical locations shuttered and operating assets liquidated. What remains is a shell, a familiar logo now attached to a purely online retailer, stripped of its original business model and competitive moat. The $21.5 million price tag underscores the scale of value destruction, decades of retail presence reduced to a brand-only transaction. For investors, the lesson is clear: a household name offers no protection when the underlying business is gone. Number 6. Virgin Galactic stands as a warning about the dangers of investing in dreams untethered from financial reality. Since its public debut, the company has completed just 6 commercial space flights, each heavily promoted but collectively generating minimal revenue. In early 2024, Virgin Galactic grounded its VSS Unity vehicle for maintenance and safety upgrades, halting all ticketed flights and leaving future operations uncertain. The financial statements reveal a stark imbalance. Cumulative cash burn now exceeds $1 billion, a figure that dwarfs the company's total revenue since launch. Meanwhile, Virgin Group has trimmed its ownership stake, signaling that even the parent company is no longer willing to shoulder the risk. For investors, the story is no longer about pioneering space tourism, but about a business consuming vast sums of capital with little to show beyond headlines and hype. Number 5. Fisker Inc. stands as a stark warning of how the SPAC boom can end in total collapse. In June 2024, Fisker filed for Chapter 11 bankruptcy after failing to secure new funding, leaving more than 65,000 reservation holders with deposits they are unlikely to recover. The bankruptcy court filings list these reservation holders as unsecured creditors, a group with little hope of repayment as the company's remaining assets are liquidated. The collapse also triggered the cancellation of a much-publicized partnership with Honda, erasing any hope for a last-minute rescue. Unlike companies that limp along for years, Fisker's story reached a hard stop. A hyped electric vehicle dream unraveled completely, taking consumer money and future plans with it. The outcome is not just a cautionary tale for investors, but a reminder that when the underlying business fails, even the strongest stories offer no protection against permanent loss. Number 4. Open-Door Technologies reveals the risks of a business model exposed to sudden shifts in the housing market. In 2022, Open-Door posted a staggering loss of $1.4 billion, driven by the collapse of its iBuying operation when home prices reversed course. The company's approach, buying and reselling homes at thin margins, left it acutely vulnerable to even modest market swings. This is not an isolated case. Zillow's own foray into iBuying ended with a loss of $420 million and a complete shutdown in 2021, setting a clear precedent for how quickly this model can unravel. Open-Door remains highly sensitive to interest rate changes and regional price declines, with every purchased home representing a potential liability instead of an asset when the market turns. The lesson is clear. When profitability depends on timing a volatile market, a single bad year can erase years of growth and leave investors holding the bag. Coming to the top 3, Lumen Technologies stands as a telecom giant whose financial structure is now defined by a single inescapable equation: interest expense outpaces operating cash flow. The company carries nearly $20 billion in long-term debt, a figure that dwarfs its shrinking revenue base. In 2022, Lumen suspended its dividend, a move that left income-seeking investors with nothing but exposure to mounting liabilities. The most recent filings show operating cash flow at negative $598 million, while annual interest costs reached $1.34 billion. That means every dollar of cash generated falls short of even covering the cost of debt, producing an interest coverage ratio of just 0.45. This is not a distant risk, it is a present-day math problem that signals algebraic insolvency. Lumen's predicament is not about a bad quarter or a missed turnaround. It is about a business model that on paper cannot pay its own bills, an outcome that highlights the danger of chasing yield in structurally broken companies. In second place, Brookfield Infrastructure Partners offers a rare example of visible inflation-linked cash flows in a market crowded with story-driven stocks. The partnership owns and operates a global mix of essential assets: toll roads, energy pipelines, data centers, and utilities, each supported by long-term contracts that automatically adjust for inflation. The result is a 5.5% annual distribution yield with increases delivered for 15 consecutive years, even as economic cycles and interest rates have shifted. Unlike companies chasing growth through leverage or hype, Brookfield's business is built on concession agreements and regulated returns, providing steady income regardless of headlines or market volatility. For investors seeking a lower-risk alternative to the excitement and fragility of the prior names, Brookfield stands out as a cash flow machine grounded in real-world infrastructure. And finally, in first place, Constellation Energy stands as the clearest example of stability and visibility in today's market. As the largest operator of nuclear power plants in the United States, Constellation supplies carbon-free baseload electricity, a resource that is increasingly critical for data centers and industrial users. In 2024, the company signed a 20-year power purchase agreement with Microsoft, guaranteeing a steady stream of revenue for decades and locking in demand from one of the world's most data-hungry clients. This long-term contract structure is rare in public equities and provides a level of cash flow certainty that speculative names simply cannot match. The company's inclusion in the S&P 500 in July 2023 further validated its position, attracting a surge of institutional capital and reducing retail float to just 11% by the end of 2025, where most stocks on this list are defined by hype or hope. Constellation's business is built on durable assets, locked-in contracts, contracts, and a visible path to future earnings, making it the definitive alternative for investors seeking security over story. Across all 10 stocks, one pattern is clear. Hype and brand recognition can persist long after fundamentals break down. Durable returns come from cash flow, not excitement. In today's market, the most dangerous investments are often the most familiar. True resilience is built, not branded.